Welcome, everyone. So glad you're able to join us today for HDL's latest California sales tax trends and forecast webinar. Before we get started, just want to let everybody know that this presentation is being recorded and will be available along with the slide deck. And I know that's probably going to be most important for a lot of you today. But both the recording and the slide deck will be available on our website, hdlcompanies.com, very soon. All registered participants will also receive an email notification when those are available. So probably give our wonderful marketing staff and others a chance, but probably in about a week or so, we'll get both the video and the slide deck up for you. Also, during the presentation, if you'd like to ask questions, feel free to open up the chat conversation box at the top of the screen there. Feel free to type in questions or thoughts that you have as we go through the webinar. Those of us on, myself, Susie, and Ken, will either be trying to answer some of those questions in the chat box, or we'll save them to the very end for a Q&A session. But don't hesitate, as your ideas come up and thoughts and questions, just go ahead and put them into the chat, and we'll make sure that we try to address them all here within the next hour that we have with you. By way of quick introduction, myself, Bobby Young, I'm Client Services Director here at HDL Sales Tax. I'm joined today by Ken Brown, Susie Woodstock. We've all been here on the webinar before, so probably some familiar faces for all of you. As again, as Ken mentioned, we see you guys popping in to the webinar. We're familiar with you as well. A little bit about HDL. We've been in business here in California, especially for over 40 years. We're working on, I think, like 42, maybe. We are 100% employee owned, which we, as the employees, hold so dear. It really gives us the flexibility and kind of I'd say the fluidness to provide you the services that we feel you need and be able to really customize what we provide for you. But we are blessed to be a company that now spans the entire country, coast to coast. We work with over 900 municipal clients, a lot of revenue recovered. But I would tell you that we are blessed to have such a strong client retention rate. To be able to serve you and keep you guys happy is a big priority for us. All right, here we go. Let's jump in. Fourth quarter results. 2024 fourth quarter, as a reminder, October, November, December time period, holiday shopping included with that, highest generating quarter of the calendar year. This is kind of when we dive in deep and try to figure out what we as consumers, those are the two hats that we always wear, right? Kind of remind ourselves of that. We're personally consumers as well, but what did we do back during October, November, December as a state? Statewide, you can see down at the bottom here, down 1.2%. It wasn't positive from a comparison with the prior year. We were hoping it might be, but our anticipation was that we would actually be a little negative. And I would tell you, the 1.2% being down wasn't a big surprise, but it was just a little softer than what we had originally thought just last quarter when we were trying to figure out where 4Q would be. As you see here, I've boxed up those industries that dropped the most, created the most volatility through. Both Ken and Susie throughout the webinar will be really diving in deep to these categories. But just again, a little bit of a primer here. Autos transportation down 1.3% statewide, building construction down 4%. No big surprise because we have seen an extended period of time where both these categories have seen decreases. And I'll show you one, and I know Ken will be going in deep on both of those for you, but hadn't quite seen any positive trends out of both those industries. Also, fuel and service stations down big, 14%. We had seen gas prices drop dramatically during the October, November, December time period. Again, Ken will be talking more about that coming up, but think crude oil prices definitely down, pulled gas prices down. That left us, negative at the bottom. A couple of industries, maybe it doesn't show up, they're highlighted in yellow. We did see some positive growth, both out of restaurants and pools. Susie will be talking about these through the presentation, but they ended up giving us a little bit of a lift. And I would tell you then that's the bigger difference or where we ended up thinking it wasn't going to be quite as good. And all right, it was a little better than what we thought, only down 1.2% this quarter. As you see here on the right side of the screen, throughout the entire state, very, very similar results. Sacramento region's got a little something different going on. Think a little bit more on terms of fulfillment centers within the region there helping out. But everybody else still saw kind of that same relative decrease over the prior year. What does this look like visually? I think this one's going to be pretty important this quarter. The top graph here you see on a quarterly basis. Okay, yep, we've seen this trend. Fourth quarter, as we see here in the peaks, normal. It's why we end up generating the most amount of revenue here in 4Q. You can visually see that. But overall, this time period represents about 3 years. And you can see how flat the line is, slightly trended down. Fourth quarters have been a little bit less. I've got another slide to show you that a little bit more tangibly, but most important, I think, is the bottom graph here. This sets us up statewide revenues, statewide receipts, right, over the last 13 years. So going all the way back to 2012, a reminder there, we were coming out of the Great Recession, right? We saw steady growth and on a niceward trend. In 2020, just as a reminder, how could we all forget? But we had the pandemic, right? So we saw the drop. Feds pumped trillions of dollars into our economy. We as consumers all spent it. We drove sales tax revenue receipts up during 2022, was probably our peak here. Then we started to level off, well, 2023 and 2024, right? As a reminder, or thinking about this, is shown on a calendar year basis. I know a lot of us think on a fiscal year basis, but here we are at the end of the fourth quarter. Let's look at it on a calendar year basis. You can see we've regressed, right? We've had 8 quarters of regression now, and we're basically just regressing back to the trend. And that's why I think this graph is so important here. You know, you scope out over the last 13 years, you put in the trend line, and wow, we're just pretty much right back on trend. So even though we felt this sales tax lag a little bit, right? 2 years of negative year-over-year declines, but we're coming off of a period of extreme growth that was never going to be sustainable in the long term. And where we've gone, we've regressed, but just back to the trend line. That's more of a phrase for me. And I've looked at a couple of agencies, especially over this time period, and it's been very similar, right? So as you look to communicate out to others, maybe let's look at your agency trend line and kind of see that, kind of what's going on, and are we just going back to the trend? Here you can see one of the things you'll see in your quarterly packets this quarter is a graph that we show online versus brick and mortar and how that compares, right? No big surprise there. How much of us as consumers, we switched over to shopping online during the pandemic. That trend hasn't really changed. Plus, we had AB 147, Marketplace Facilitator. We've talked all about this in the past. Most recently, over this last calendar year, what you see is a little bit of an uptick here on the online portion. And yes, that little bit of steady decline out of brick and mortar. As a reminder, for brick and mortar, especially with large retailers that also sell fuel, because we've seen those fuel impacts, that's also going to hurt this line here when we think about brick and mortar. Susie's going to go in even deeper here on general consumer goods. But the main takeaway that we wanted to communicate with you is in the fourth quarter, consumers were still shopping, right? We as consumers were still buying things. The economy was fine. Not a full regress. It's just a matter of, okay, has it continued to kind of shift where we're buying goods from? So a little bit more online, a little less on brick and mortar, but we as consumers are still shopping. Let's talk now. So those were the results, right? Let's talk about the forecast coming up and where our team sat around, gosh, what was it, like about 6-7 hours 2 weeks ago when we got data, try to figure out, okay, what happened? What do we think is going to happen? Where we placed a lot of our efforts and conversations were here on the left side, interest rates, right? As we've seen, and we know, I've got a couple of slides coming up, Fed Treasury, and kind of thinking about where the Fed funds rate is going to be. How does that get over to us as consumers? We haven't seen a dramatic drop yet. And yes, the Fed's talking about maybe not having too many more coming up. And that's going to trickle over into accessibility of credit, the desire for us to access credit, and also built up home equity. When we listen to Ken Brown talk about building construction, what does it mean when homeowners, it's not so advantageous to tap into available equity? That's going to end up, tempering expectations when it comes to sales tax revenue. Tariffs and inflation, all the conversation. If you take nothing away from today, it's probably going to be that we spoke a lot about tariffs throughout the entire webinar. Obviously, we've got considerations of what does that mean for us as consumers and our spending habits. And then also with gas prices, you heard me mention, yes, gas prices have been lower, and that's pulling down receipts. But we have it here boxed up in green because it's kind of a good thing for us as consumers, leaving a little bit of leftover money, especially more return to office scenarios, folks having to commute in. If we don't end up having to spend as much on gas, it leaves a little bit of money for travel and dining. And Susie will be talking about restaurants. We saw that at the front end. Saw some nice steady returns out of restaurants. So these were top of mind for us all the way through our forecast meeting. Let's talk a little bit about interest rates. This is just kind of recapping where the Fed Treasury has their target, or at least has the Fed funds rate. Saw reductions at the end of 2024, a little bit here at the beginning of 2025. It's nice. Is it enough? I think a lot of us would sit around the table and say it hasn't been enough. I would tell you, as far as our forecast goes, we were anticipating more declines probably during the period early 2024, to spur the economy along, maybe not put us in the position where we feel like we are today. We're a little bit stagnant, a little on edge. What's going to happen? What are the Feds going to do? When can we start tapping that credit and that equity? Here, just visually, where the Fed's rate target has been and how it's changed. You can see the lightest line for a September projection was definitely dipping down lower. Most recently, as of December and March, they've held it fairly steady. Not too many rate reductions expected for the remainder of 2025. I know that's what they're telling us. For those of you who know me and we've talked about it, my expectations, my hope as an eternal optimist, is that we would see the Feds, cut interest rates a little bit more. Conversations that come out of the Fed, there's that, okay, they're now watching the economy a little bit closer rather than just traditional economic factors that they would want to consider. I think we're right on that edge as an economy to kind of go one way or another. And the Feds, especially with interest rates, could manipulate that. Now, I would tell you, when it comes to our forecast, we're definitely leaning more on what we're hearing rather than that feeling of what should happen. So that's where I'm going to talk about kind of how we've altered the forecast just a little bit. Goods versus services, and you can see right here at the end of 2024, kind of got it back to 0% again. And the red line that you see here is core goods. Okay, so you heard me mention before, you'll hear Susie mention later, consumers are still shopping and spending. It's just not dramatically higher or more than what we did a year ago. It's actually just slightly less, but people are still spending. Obviously, when it comes to services, which is more of the lavender line, many of us have kind of transitioned over, right? And kind of, instead of buying goods, buying experiences and traveling and doing some other things. So we as consumers are still spending. Then how does that trickle over? Another one of our markers, and we've got quite a few that the team keeps track of, but savings and disposable income, quarter over quarter. How has this been trending? You can see here our big takeaway, fourth quarter, very similar to third quarter, right? In terms of a percentage, just slightly less. The reason why we're watching this marker is, okay, are people digging into their savings a little bit more, right, than we had historically. You can see here as we go back, pre 2016. For the most part above 5%. Obviously, the pandemic and the Fed's given us money. We put it into our savings, and then we ended up spending it all in 2022. The savings have been rebuilt otherwise. But over the next 6 to 9 months, what are we as consumers going to do? Are we going to dig in more, have to dig in more because prices are higher with no relative relief? Or will there be kind of more of a steady state that we'll be in compared to now? A little bit more on tariffs and the uncertainty around tariffs. And as we, as our team, sat around, we could all very easily say, "Hey, there's a lot of uncertainty," right? And I believe what we wanted to be able to do was define that a little bit, right? And really kind of then, okay, yeah, tariffs is a big broad category. Obviously, it's taking up all the headlines out of the major news cycles right now. But what does it mean? Here you can see a graph that was put together as far as expected impacts to tariffs on China, specifically in companies that either produce goods there and ship them out, store goods there, ship them out, just kind of what it was going to mean and their potential exposure. I think as much as we hear about tariffs and it's this kind of guerrilla, if you will, it's like, well, what is it really? As we might all assume, for here we've got Amazon, and their potential exposure is only 25%, right? So it's yes, we saw an increase as far as the tariff on China that was already implemented, but the exposure really wasn't that much. And I know Susie's going to talk more specific. Well, even Ken's going to talk more about autos. Susie will talk more about general consumer goods coming up. The other piece of the uncertainty really does reside with, okay, what, in terms of what tariffs are going to be put on and to who, right? Or the where factor, and also the rate, and it varies. Okay. So whether we're talking about alcoholic beverages, automobiles, this very broad category, which I kind of get a chuckle out of, but blanket tariffs and especially reciprocal tariffs. As we get the question, hey, what are tariffs going to do to sales tax? It's like, well, it all depends, right? And that's the part of the uncertainty or the definition is like, well, what tariffs are we talking about? If we're just talking about blanket tariffs and reciprocal tariffs, boy, we'd all sit there with our hands up with an unknown. And you can see here how many countries kind of fall into the blanket tariff category with 20% to unknown, right? It's just, well, depends. How much do they put tariffs on the U.S. to then, okay, this is how we're going to reciprocate, right? So a lot of uncertainty there. A couple other categories trickling into the general consumer goods, and I'll leave some of that for Susie and Ken to talk about. As we communicate out and as you communicate out, really, okay, how do we put that into context for others, right? And again, further define the tariffs and the impacts. These are some takeaways that I wanted to provide to you guys is, well, let's consider what are the proposed tariffs and what will they actually be when enacted and at what time? Right, as we hear day to day, and I think it's like, yeah, hey, yesterday it was one thing, today it's a different thing. It's really kind of put that out there, right? It's like, no, this is really a thing where it can't be so defined because we don't know exactly what it'll be when it's enacted. Anything late in 2025, just as a consideration, we all know that's part of the FY 25-26 forecast. And okay, when is it actually going to hit consumers? Another big consideration, and this was probably 2 weeks ago, is the feds were talking about a government shutdown and trying to avert a government shutdown. Will there be future congressional bills, and what'll be entailed there? Possibly to offset and think of like income taxes and other things that may kind of then offset the impact of tariffs. I know even a week ago it was okay, let's reduce interest rates to purposely offset the impact of tariffs, right? That leads into a whole nother conversation. But then also, okay, We're talking globe, we're talking the US. Let's really focus. How will it impact California and local consumers? So, local consumers to you guys in your local communities, how are your consumers going to respond? Very different for different communities. And the thing to keep in mind that I like to keep in mind, yes, we all know about discretionary spending, right? Spending when we've got extra money. But I also incorporate this definition or term demand spending, which is simply the normal demand for you and I to live our day-to-day lives. We have to buy food, we have to buy goods, we buy fuel. If your car breaks down, you're going to end up having to replace your car in order to get to work, right? So I put a lot of that into kind of our demand spending, our baseline spending. Keep that thought though as I continue to go forward and towards the end, because I'll revisit that. Here visually, as I wrap up and get ready to turn over to Ken Brown, the trend, right? We've had 8 quarters now, 2 full calendar years of declines. You can see what that means here. It hasn't been so dramatic. We as consumers, we still been spending, but it's not nearly what we were back in 2022, right? And it's been softening. And then what we've seen most recently and what our forecast now is for the next 2 coming quarters, we've definitely slowed down our expectations. We had anticipated if the Feds dropped interest rates that, yes, we as consumers, as soon as we turn the calendar year with low interest rates, we'd start spending. We've softened up both 1Q and 2Q slightly. And then for all of fiscal year 25-26, we pulled it down about 0.9%, almost a full percent, from 2.6 down to 1.6%. Still growth. I think that's a major thing when we think about fiscal year 25-26. Still think there's going to be growth there, just not nearly as much as we did last quarter when we had that anticipation. Okay, the Feds are going to be touching interest rates a little bit more here in 2025. So we softened that up. All right. I think I went pretty heavy. Ken Brown will be talking about autos and the rest.
Okay, so bear with me as I transition to autos. I'm going to talk a little bit here about the tariffs because I know that's really foremost on everybody's mind. And in terms of autos, there was a lot of stuff in play. Originally, the first thing that came down the pike was 25% aluminum steel imports, which did go into effect. That went into effect March 12th. And that is impactful in terms of auto pricing because Barclays Research is indicating in their analysis that that will add about $400 on its own to the average cost of a vehicle that is sold. So that is an impact right away. And then secondly, we had this conversation back and forth with Canada, Mexico, United States, and there was initially some tariffs imposed. Then later that was watered down, at least temporarily, so that goods that complied with the United States, Mexico, Canada agreement negotiated in 2020 basically would be exempt from a 25% tariff, but that didn't leave everything out. There was still some cars that are sold in the United States that are subject to that even now. And so there's a list here from an article cited down below. And then still outstanding was essentially April 2nd. There's these, as Bobby mentioned, reciprocal tariffs that are under discussion. And then also at that point in time, it was off, then it was on, then it was off and on again. Is this potential for specific tariffs to the automobile industry as well as to other industries, including lumber and others around the state? So late yesterday afternoon, I had to completely, and you can see my X's here, is do it again, mark it up there, cross it out, and had to get to work. And so late yesterday afternoon, it was announced that yes, indeed, there will be a 25% additional tariff on all cars that are imported from outside the United States. And I think it's important to note that it's not just imported vehicles, it's also vehicle parts. And so you have an instance now where the global auto market is so interrelated and interconnected that you could have cars manufactured within the United States, but a substantial portion of their parts are coming from outside. So for example, BMW is a good example. I understand that basically all their engines and some of the other parts are manufactured in Germany, no matter where they're assembled. So this is going to impact not just, cars manufactured outside the United States, but also a substantial portion of parts. And so some of the data that I was able to find is that basically about half of the cars sold within the United States right now are essentially coming from outside. They're imported. And so you can see a list here of the different manufacturers and the largest number of units by manufacturer imported from outside the United States, led surprisingly by General Motors, with a lot of those cars manufactured in Mexico. But even for cars manufactured within the United States, I mean, I've heard that basically about half or maybe even 60% of the parts in automobiles are coming from outside. So, of course, there's going to be a big incentive on manufacturers to begin to move that into the United States, but that, of course, is costly. It'll take time. As of now, there's a wide variety of estimates in terms of how much these tariffs are going to raise the cost of manufacturing vehicles. And I think one reasonable estimate that I've seen from Cox Automotive is about $6,000 for at least the imports from Mexico, Canada, maybe something along the lines of $3,000 for all vehicles. I've seen other estimates, Anderson Economic Group, $4,000 to $10,000 per vehicle, depending. Some as much as 12 or more for certain electric vehicles. So some of these tariffs aren't necessarily 100% going to be passed on to the consumers. In some cases, that may be absorbed to some degree, but you also maybe see some sort of hidden cost passed on. For example, we've become accustomed as consumers to taking advantage of those sweet 1.9% financing rates that are sometimes offered, and those just may disappear. And so that could ultimately result in a substantial cost that you may not necessarily see. So ultimately, it's hard to know exactly how this is going to shake out, but some of the better estimates I've seen count on maybe around $3,000 per vehicle on average, depending, with a wide dispersion around that mean. And some of that is certainly going to be borne by the consumers. Some of that may be absorbed, and then some of it over time, those parts may begin to be manufactured within the United States. All right, so what does this all mean for you as a city or a county jurisdiction with perhaps a lot of automobile dealerships? And what is that going to mean for your revenue? And I think in a lot of cases, this really reminds me, and as I dug into this, some other analysts as well, in terms of COVID in some ways, right? So, in COVID, we had a situation where all of a sudden production stopped of vehicles. And so that led to lower inventory on dealership lots, higher prices. Dealerships began to sell only their most expensive, highly optioned vehicles. There was very little negotiating power. Most vehicles were priced selling way over for a sticker. And so paradoxically, it actually meant sort of counterintuitively that a lot of jurisdictions, we saw that surge in revenue. And so even though lower unit volume was being sold, there was actually more revenue, substantially more revenue coming in. And so that was sort of a strange time. And so you see that over here on the left of the slide. And in many ways, some of these things are very similar in terms of what's going on. And in fact, Cox Automotive Chief Economist Jonathan Smoke was quoted just yesterday on a webinar saying, bottom line, this is going to result in lower production, tighter supply, and higher prices around the corner, reminiscent of 2021. And so he also is sort of drawing a parallel to those COVID times. But I think there's some really key differences. And that's what you see over here on the right side. And this is a little bit more worrisome. So the big one is that unlike during COVID, we don't have a lot of increased liquidity in the markets. We don't have easy credit, as Bobby was noting, that the Federal Reserve is maintaining its tightness in the face of this, at least for now. And also not a lot of government support payments. And in fact, sort of the opposite right now, as federal government is downsizing. There has been potential rumor for future tax cuts or refund payments, but as for now, those are not yet in place. And so there's a lot of uncertainty around this and also fear of retaliation, right? So, I just saw yesterday a quote that um, Germany and France are already talking about potential retaliations. And so, we just don't know how this is going to play out. And I think also the wealth effect that we've been benefiting from over the last few years with rising stock market and the housing market being very strong, that may be petering out a little bit. And so you can see the history here of what the new car cost. We expect this to go up with these tariffs. Vehicle inventory sale ratio is still very low. I think I told the story about shopping with my mom for a new car the other day, or actually it was in November. And even then, there was a shortage of key vehicles. We couldn't find any Toyota RAV4s. And so just imagine what this is going to do once these tariffs start to go into place. We got pretty restrictive credit conditions, similar to the Federal Reserve being fairly tight. And so a lot of push-pull. And so the good factors here, we've got an aging fleet, we've got 5 years of pent-up demand of below normal purchases of vehicles. We've got a fairly robust job market, unemployment around 4%, which is historically good. Wage growth is at a 15-year real-time high. And also, I think consumers, to some extent, like my own mom, will be rushing to get ahead of tariffs. So we think we may see a boost from that in the short term. But in the intermediate to longer term, some of that demand's being pulled forward. Economic growth projections by key analysts are being lowered. Consumers are stretched, right? We've got high car prices, high financing rates, relatively speaking, if you can't get one of those deals, high cost of living. And so consumers are really feeling it. And, as we know, higher tariffs results in higher cost and therefore less demand. So a lot of things at play. But there's still a lot of uncertainty about this. I was just reading that basically the stock market, Wall Street Journal had an analysis basically saying that the automaker stocks are not selling off as much as you would think, given the hit to their bottom line that should be coming based on this policy change. And furthermore, the president of Mexico was just quoted as saying that she thinks that there's still room for negotiations. So the big question is, does this really stay in force? And if it does, for how long? And if it is, is it even implemented in the same manner that we've heard proposed yesterday? So in terms of our forecast, we came very close to our forecast for 4Q, but we are lowering our forecast for fiscal year 25-26, basically reflecting all the issues that I just walked you through, and the increased uncertainty associated with the all these outstanding issues. So we're looking for about 1.4% growth next year. Fuel and service stations, I'm going to fly through this real quick because we did come in very close to our projection. We came in basically within 1%. We were looking for a 14% dip, and we came in down 13%. And so very, very close. And our forecast reflects that. We don't have a lot of change in that for 25-26. We're looking for about 3% growth in sales tax next year. Building and construction is another sector heavily impacted by tariffs and economic policy and interest rates. And so aside from interest rates, which we've talked about a lot today, we've got a number of unique factors, including fear about changes in Washington potentially impacting federal funding and reimbursements for a variety of projects, infrastructure, low-income housing, and even here in California, high-speed rail. We've got worries about how deportations might impact an already stretched construction labor force. And of course, tariffs. Tariffs are not yet necessarily in place specifically on lumber, but they are rumored to be coming down the pipe, potentially at 25%. We'll have to wait and see. But industry analysts are projecting that these things in play could add potentially 10 to 15K to the price of a home. And we're tracking a variety of various commodities here associated with building and construction, which you can see. But in summary, the high price of housing right now is really locking up the market. It's already high. Mortgage rates, consumers seem to have adjusted fairly well to the 6.5% mortgage rates that we're seeing now. But that combined with the high prices has really locked up the market. And until interest rates fall a little bit, we're not expecting too much in the way of future growth here, particularly, pardon me, as the stock market and some of this wealth effect dissipates a little bit, given the uncertainty. So we are looking for a 1% decline in building and construction next year. This is one of the areas where we have lowered our forecast a little bit more than some of the other categories, awaiting these Federal Reserve interest rate cuts. And so we think there's a lot of potential buyers sidelined right now, waiting for these interest rates to fall before they make their next move. So we're pretty cautious on this industry group. There is expected to be some boost from fire rebuilding, but that's expected to play out over an extended period of time as homeowners negotiate with their insurance company to payouts, and of course, be concentrated mostly in the Los Angeles, Southern California region. In terms of food and drug, I won't spend too much time on this because it is our smallest group, though it is very interesting. It accounts for about 4.4%. But basically, the major trends at play right now include cannabis sales declining significantly. You can see that here, down 10%. A lot of drugstore closures. And you also see some of those impacts that are negatively impacting drugstores, such as online competition from shopping like Amazon, buying certain things there. That's also plaguing certain segments of the convenience store category as well. So we're seeing some stores downsize, various outlets close up, and a lot of barren shelves out there too. So a lot of things at play. Cannabis, we expect that that's a 3-year downtrend for cannabis sales since the peak here in 2021. So we expect some of those trends to continue. And for pretty modest growth, we're looking for actually a slight dip next year. For the year as a whole in 25-26, about a 0.5% decline. That concludes my part of the presentation, and I'd like to turn it over to my colleague Susie.
Thank you, Ken. The next 3 major industry groups that I'm going to talk about all have a portion of retail general consumer goods. So I'm going to start with how those are allocated. First off, we have the brick and mortar portion, which is the direct allocation to the agency where a store is located. This is the physical stores in each agency. This is 100% of the general consumer goods category that we talk about. The other portion of retail is in the online part. If the merchandise is coming from out of state, it is indirectly allocated to the agencies, and it goes through the pools. This is about 59% of online sales. And the last is online that comes from an in-state warehouse. It goes to direct allocation to where the fulfillment center is located. Right now, that is about 41% of online sales. That goes in the business and industry group here. Bobby already kind of touched on the difference between online and brick and mortar. I'm going to zoom in a little to talk a little about total retail sales. So here I added an additional line, and this is percent growth. His graph was talking about total dollars. So we can see the top line is the online. We are seeing that continue migration to more online shopping. The bottom is our brick and mortar stores that we have been seeing some slowing in. We had a little bit of a bright light here in first quarter, but we have continued to see slowing for the rest of the year. Again, this was the holiday quarter. Overall, fourth quarter was up, the yellow line, for total retail. Just a quick touch on the tariffs here. There's a lot of possibilities of what it could apply to in general consumer goods, both for online and in-store purchases. We're not expecting a significant negative impact, though. As prices go up, of course, sales tax can go up. It can lead to people purchasing a little bit less. But overall, we feel like shoppers will continue to look for the deals, both in online and in the stores that they choose to shop at. So we don't have a big negative concern right now for general consumer goods. Now I'm going to jump into the actual general consumer goods category, which is the brick and mortar stores. If we look at this across, these are the top 10 categories in general consumer goods, and we see a lot of red. 7 out of the 10 categories were down in this quarter. Family apparel category here, which is about 15% of the overall group, was actually up about 1%. This is the category where a lot of the off-price concepts are, which is, again, when consumers are looking for some of that value in spending, these are the types of stores that they're going to. Discount department stores, Bobby mentioned, this can roll in some of the fuel. So some of these stores offer fuel pumps at their locations. So when we saw fuel was down 14%, that can impact this category a little bit. Discount department stores is about 34% of our brick and mortar general consumer goods. Electronics and home furnishings have been trending down since 2022. And even though we're still seeing negative results here, these are the smallest declines we've seen since it started going down. So, that is a little bit of good news that it's not declining as much as it has been over the last 3 years. Jewelry stores, we think there's an anomaly here that is boosting this up. It has to do with some of the timing in that category. Publicly traded companies will often report their future guidance. So this is how the retailer guidance has changed. We just saw that electronic stores were still down, but Best Buy has increased their retailer guidance since last quarter. Ulta has also increased their guidance. So even though Best Buy is still seeing some declines there, declines are lessened, just like we saw in fourth quarter. Target is still remaining consistent with what they were expecting last quarter, while all Walmart, Macy's, TJX, which is TJ Maxx and Home Goods, and Ross have all slowed their expectations. Overall, the considerations for the forecast for our brick and mortar general consumer goods are that price fatigue. As prices continue to rise, people will cut back or, again, seek some cheaper options. Consumer sentiment. Bobby touched on this a little. When people are worried about the economy, they tend to save more and spend less. So consumer sentiment has been trending down. And of course, for our brick and mortar stores, the growing preference for online is problematic. It's a negative impact on our brick and mortar stores. So with those considerations, we're looking at the remaining 2 quarters for this year are now projected to be down, not expecting some gains until third quarter of 25. For this year, we're looking at about a 2.2% decline overall for 24-25, and then 25-26, some modest growth of up about 1% for our brick and mortar stores. Okay, now I'll move on to the pools. As we mentioned earlier, related to retails, most of these items are coming from out of state here in this general consumer goods category. Business and industry is also a big portion of this group, and it is stuff coming from out of state. Autos and transportation is mostly private to private sales. Building and construction is stuff that is being installed. And restaurants, the food you order is not coming from out of state. This is food that a food service delivery company is reporting the sales tax on behalf of the restaurants that they're delivering for. If you look at this in the pools, you can't really see completely, but all the categories are positive this quarter. If we break them down a little bit more, general merchandise up top is about 17% of the pool. This is the exclusively online businesses. Apparel, I've got 3 of the regular general consumer goods categories rolled in here. Those are about 16% of this pool, and they were up 7%. Used autos, again, private to private, was up 1.8% this quarter. It's about 5% of the pool. Overall, these top 10 categories were up 4.3%. So again, like Bobby mentioned, the pool was kind of the bright spot. This is a little bit stronger than our projection was, and it came in overall up 4.1% in fourth quarter. The considerations for our forecast is, of course, e-commerce continues to rise. That past trend showing that people continue to opt over here. Of course, as people like about online shopping is when they're looking for value, they can compare and feel like they're getting the best deal just by looking online for the comparisons. Again, tariffs, we don't expect to be too big of an impact on general consumer goods right now. And the economic uncertainty, Bobby kind of dove into a little bit of it, but the consumer spending can fluctuate with that consumer sentiment going down a little bit. With that for the pools, we're looking at pretty solid growth here, about 3% growth for the next 6 quarters. That will lead us with 3% for 24-25 and 3% growth for 25-26. And looking at our business and industry group. Again, we've got fulfillment centers are now 32% of this. That was up 11% for the in-state fulfillment centers. Business and industry is a big eclectic group. It has medical biotech, it has different type of industrial, it has agriculture, it has office supplies. You can see really some big variations here. Overall, these top 10 groups, excluding fulfillment centers, were down 3% with energy hitting. Energy can really be the timing of some projects. We do expect 2 more quarters of some declines in energy. Electrical equipment and office equipment with some solid gains. This is related to AI projects. So as AI continues to grow, we're seeing growth in these 2 categories. Medical biotech is about 9% of our overall business and industry group, and it's pretty flat in this quarter. Again, fulfillment centers about 32%, and we're seeing that growth. It was up 11%. It follows a general consumer goods pattern with that fourth quarter spike. The considerations for our business and industry group, the fulfillment centers, again, 32% with that 11% growth. We are expecting positive gains in this group. In industry, there's underlying contraction continues supported by most indicators. So we're expecting industry to see some continued declines. Consumers are also hesitant to commit in this category. Medical biotech has a lot of concerns. Drug approvals or device approvals could pull back in this group. Agriculture, kind of concerned about the retaliatory tariffs on our food exports. Labor concerns, a significant portion of farm workers could be impacted. We've got bird flu. So while we've got positive news in the fulfillment portion of business and industry, the other 3 bigger portions we have concerns in. So rolling those things together, you can see we've got 2 more quarters that we're expecting negative results. But overall, kind of flat. We've got potential gains in 32% and some potential slowing in the other categories, leading us to about a 1.6% projection for growth in 25-26, really pushed by a lot of those fulfillment centers. The next group and the final group is restaurants and hotels. Restaurants and hotels, there's only 7 subcategories here. You can see the top 2, casual dining, quick service, is about 73%. So they're a majority of it. Overall, like Bobby said, we did have some positive results in this category. The one category that was down is fine dining. Again, people kind of picking and choosing where they're spending. They're not really splurging on those fancy meals right now. Small portion of restaurants is food delivery and catering. This can be impacted by campus. So as we're seeing some people back at some of the offices, the campus food services are increasing a little bit. AB 1228 was It requires fast food restaurants to start to pay a minimum wage of $20 an hour as of April 1st, 2024. The fast food was defined by you pay first and then you sit down. And it has to be a national chain that has at least 60 stores nationally. So it doesn't apply across the board. So we've tried to pull out what these types of restaurants are to look at what's happening with AB 1228. As of this line, this is the employment. You can see going forward after that minimum wage was required. In general, these limited services restaurants have reduced the number of employees, trying to pivot. They've already had labor shortages. They've had rising costs. They're, struggling in general, and now they're having to pay more. So they once again are pivoting. What you can see up here is after AB 1228 took effect, some of the restaurants that are required to increase their labor costs are actually still positive. Again, rising menu prices, as long as you still continue to have the foot traffic, will increase your revenue. Others are not required. They're pretty flat. A few are slowing. What we're finding is just because you're not required to, if you're still trying to attract some workers, you're going to have to pay a little bit more. Consideration for the restaurant industry. Interestingly to me, the National Restaurant Association is quite optimistic, or cautiously optimistic, that we're going to see growth in 2025. Consumers value their experience over price, even though they still want value. The restaurants want to grow their on-premise traffic, get people back in the restaurants. Again, we're going to watch what happens. The AB 1228 has not announced whether or not there's going to be further wage increases. Visit California expects international visitors to increase this year, so that will help us with the spending coming from other areas. Overall, our restaurant forecast is about 1.3% for this year. Again, a little bit of slowing, and next year up about 2.8%. Historically, if you look at the last 20 years, restaurants grew about 5%. So these are kind of slower than normal as people are picking and choosing, but we are still expecting positive results for the restaurants. Bobby, I will turn it back to you. Uh-oh, I can't hear. You're muted, Bobby.
Sorry. Thank you, Susie. my bad. Thank you, Susie. Thank you, Ken. In the deep dive, fun reminder on the restaurants is that even back during the Great Recession, restaurants is that category that did not drop. Everything else, we as consumers, we stopped spending on a lot of things, but we kept eating out. So fun enough it'll be to watch the restaurants here as we continue on. Okay, Susie and Ken took a deep dive, gave a bunch of information there on the individual categories, and so much for us where, we sit around and kind of brain think a lot of this information. Our desire is just to give it out to you, and unfortunately we only have about an hour here to do it in the format of a webinar, but so thankful you guys stuck with us. Still hang on, because we got some more that we're going to be talking about, some big things. But to recap then, our forecast and where we're at. You see on the screen here for the current fiscal year, still seeing that down 1%. Just last quarter, we were thinking it was going to be down 0.8%. So very close. We're still kind of there. We just softened it up a little bit, given the uncertainty, tariffs, inflation, all the like. And then really, as we look forward, and as we know, our clients are continuing to plan ahead. You can see here for FY 25-26, positive growth, but only 1.6% a year. Just last quarter, we thought that was going to be 2.6. So again, softened it up about 1%, but still positive. And then it's really not until 26-27 where we see getting closer to 3%. As you look in the outer years, you can see obviously a little bit closer to 3.5, which is more of our historical normal growth. When we're, kind of thinking about, okay, we did soften it up, the reminder, and I think both Ken and Susie talked about this, right? As we think about inflation, this is just a reminder for everybody. When we think about inflation and sales tax, it's not necessarily a direct correlation. If prices go up, but we as consumers buy the same amount, we're going to expect to see sales tax revenue continue to increase. So even as we think about tariffs and the possibility of inflation and higher prices, it may not necessarily all result in negative declines for our sales tax stream. Also, as I kind of wrap up here, just a reminder on the chat feature. Feel free to drop in any questions, any thoughts you may have. We've got our Q&A coming up, but if you'd like to throw something at us, feel free to do so in the chat. Talking points or just kind of bullet points. The takeaways, right? Interest rates, long-term financing, big with autos and building construction, most tangible for us as consumers. Tariffs and the impacts. We spoke a lot about them. Yes, there's a lot of uncertainty, but hopefully we start to get a little bit of clarity, or just us as consumers, we'll go ahead and absorb it and keep moving forward. Stock market, and every day that I check the stock market, I'm really thinking about it with regards to our high-end consumers. So if your community has a bit more of a high-end aspect, go ahead, keep watching the stock market and see if there's some correlative factors that maybe you yourself can kind of see, like, hey, I know what our community specifically is going to do because either the stock market's going up or the stock market's pulling down. A reminder for me, always demand spending. Where is our bottom? We've gone through 2 years of declines, right? 8 total quarters. Are we at the bottom and then start to see some projected growth up? I would tell you, as we sit here today, and as we softened up both 1Q, 2Q, we're almost there, right? I think we're almost at the bottom, ready to go ahead and see some growth. It's just a matter of to what degree. And again, Feds and interest rates, tariffs will probably play a part of that to varying degrees. But the next 6 months could be pivotal. When we talk about Fed funds, what is the chairman going to do? What is the board going to do there? The committee, what is the president and the federal administration going to do with regards to tariffs? How's it all going to come together? Probably get some clarity, unfortunately, over the next 6 months, which doesn't need, we know that doesn't leave you as our clients in a great position while you're planning for fiscal year 25, 26. But that's the time, that's where we're at with the economy, right? It's we're just right on that razor's edge of could go down, could go up. But the next 6 months probably tells us the story. So as a little bit of a reminder there, our team is heavy at work putting together your forecast, because while we do talk today about the statewide and we look at all these trends, we don't just put it into our system and then, dump out a number for you. We really do go in person by person, principle by principle, into each one of your data to really customize it for what your community, the impacts positively or negatively back to your community. So just a reminder there, we're working hard to get them all done and get them to you, because as you guys are in those planning sessions, just be patient with us. It's coming. We've got meetings that are going to be scheduled both in April and in May coming up, but we know how important the forecasts are for you, and trust us, we're working pretty heavy on it. So that reminder, don't leave just yet, because we've got a couple of things that we want to talk about, most notably AB 2854. Some of you, especially those of your agencies that have tax sharing agreements, you may have already heard about this assembly bill that got passed last legislative session. For those that haven't heard, this is AB 2854 is simply a reporting requirement relative to tax sharing agreements. Okay, there are some bullet points that you see down below here as far as what you and your agency need to do. All agencies need to report to CDTFA. If you don't have any tax sharing agreements, you still need to report 0 to CDTFA. So let's not miss that part. Those of you that have tax sharing agreements, some of you have already kind of complied with this, because as you see the second bullet point right here, required to maintain a visible hyperlink on your website, your city's website. So if you have tax sharing agreements, but you don't have them posted, the contracts and all the information that's required under 2854, work towards posting that information on your city's website. Create some links and put that there. And what you'll be doing is provide CDTFA with those links so they can grab that information. Okay. These additional bullet points here, CDTFA will email a link for the reporting form to all agencies but it's going to come from the email account jservices@cdtfa.ca.gov. Make sure with your IT folks that jservices goes to who you want it to go to, or just make sure it doesn't end up being blocked or in junk folders. So make jservices@cdtfa.ca.gov kind of fully accessible for city staff. The other bullet point here, CDTFA will also be making information available in the city's box, which is CDTFA's portal for each agency, the BOX box. But you need to access your box, okay? So if you haven't yet, or if you're not sure if anybody at your agency has been set up, feel free to reach out to Harmeen at CDTFA, and I've left her email right here for you to jot it down. I'm going to hang here for just a minute on this slide so you can kind of jot down the appropriate information. But reach out to Harmeen. Make sure that folks that on your staff that either are required to get that information. You have to be on your resolution for confidential information, but make sure that you've got a good access into the box to be able to then get the information for 2854. Also, here, there is an upcoming webinar. In fact, I just got it this morning, emailed it out to our entire team, but Cal Cities is going to be doing a webinar with CDTFA to walk through all of the reporting requirements and anything else that CDTFA wants to broadcast. They're going to do so via Cal Cities. So the webinar is going to be on Thursday, April 10th from 10 to 11. You can sign up for the webinar on Cal Cities website, calcities.org. As you go to the website, just go down a little bit. They've got some upcoming events, and part of that is webinars. You'll see the webinar for AB 2854. Click on that, register it, attend the webinar on April the 10th. All right. Oops. Next up here, as a part of our normal fourth quarter deliveries, the other things that we're going to be bringing out to you this quarter, along with fourth quarter results, an updated sales tax forecast, calendar year reports. We're also going to have our Econ Solutions, California Retail Analytics, and your local agency surplus gap analysis. It's a great information for especially your econ development team or community development team. Good insight as to retailers, what they're looking for, contact information. So valuable. Be on the lookout for this when we're in your quarterly meetings. We'll also have the retail analytics available on our website, hdlcompanies.com. So keep an eye out there, but be ready for that. Last but not least, I'm also going to be doing a webinar with another HDL employee, Connor. We're going to be doing this in coordination with ILG, the Institute for Local Governments, and talking about budgets and revenues and kind of all encompassing. But that too, this is the funny part about it, that too is on April the 10th. It's at 11:30, gives you a small break there from the CDTFA Cal City webinar. But we'll be doing a webinar from 11:30 to 1, just talking about all things revenue streams. And we've got, let's see, who do we have on that one? Brett from the city of Sassoon City with joining us to talk about what's going on there and how he applies a lot of what we do for you as a client back to his day-to-day. Q&A, here we are at the very end. Thank you guys so much for sticking with us. We really appreciate you grinding this one out. We had a lot of information. Again, as a reminder, we're going to make the webinar available and the slide deck. Give our marketing team just a little bit of time to get that available to you. If you've registered for the webinar, you're going to get an email link with that. And I think they even now put some things into the chat, at least from our side. And let's see, did we get a couple of questions? I know both Ken and myself tried to answer some of those questions for you previously. Let's see. Tax return reporting is for what date forward? Oh, so back here on 2854, the reporting period is going to be the fiscal year 23-24, so the prior fiscal year. Those that reporting is going to be due April 30th, 2025. And then each year going forward, you're going to update the website and the links and the information communicated to CTFA based on a fiscal year. So we've got 2023-24. Then, a year from now, we're going to be focused on 24-25, that which you're kind of ending right now. So there's a nice long gap in there to let you guys do your annual reports and normal closing the books and audit and all of that good stuff at the end of the fiscal year. Then we double back to the requirements under 2854 just to get those posted. Do we know when CDTFA will be sending the link? Here for 2854 Alberta, we do not, but best to at least talk with your IT department on the J Services email. Just make sure it's not blocked and it goes through. And also, if you haven't already, check your city's box with CDTFA. Right? They may have already posted some of the information in there. We don't have a box as HDL. You guys, the clients, do. So we're not sure if they posted anything in there yet. At a minimum, register for the webinar and hear what they have to say there.
And somebody else put a link in our chat here. Yes. That is, the form has been released. So there is a link here in our chat right now too.
Wonderful. Oh, Sarah got that. There you go. I see that.
Thank
Wonderful.
you, Sarah.
Yeah, thank you, Sarah, for that.
Also have a question from Roland. Is the forecast on the drop in sales tax for 2025 reflective also in the pool for both Bradley Burns and the district tax?
No. So keep in mind that district tax is going to function differently than Bradley Burns. So what we look at today in all of our overall forecasts, this is solely based on Bradley Burns, right? And then your local district tax will may perform different depending on your local community. And also relative to your Bradley Burns, it's going to function differently. If you have a lot of car dealerships and that TT is not going to be, they're not, same to same. It really is. When we talk about transactions use tax, it's dependent on what your local consumers are buying and having shipped into the city. So thanks for that question, for sure.
And I think the second part of that question too was associated with the pool, and we did do, it's all rolled up together in that final forecast on which we're looking at right now on the slide.
Oh.
But there was a separate forecast as well for the pool, a separate slide on that.
Yeah.
If I'm understanding it correctly, I think I got the question. That's how I understand it.
Cool. Do we have any others? I was scrolling through, but then there's a few that popped in here late. Let's see. Oh, Emily had a question here. Is tax sharing agreement sales and use tax only, or include property tax too? It only includes sales tax, and it does not include property tax, and it does not include any sharing that a local agency does with another local agency, whether that be another city, let's say a neighboring city where you guys might split revenue of a retailer, or if you share with the county as a county share program. Maybe that was, kind of way back in the day for public safety services, whatever that might be, that is not required to be reported under 2854. It is, that's, property taxes and other local jurisdictions. You can exclude those. All right.
We have a new one from Marcus.
Okay.
Do you know if there's no sales? Do you know if there's no tax sharing agreement? Is there still a requirement to have a web page saying that none exists?
So there may be. Marcus, you always come out of left field. I appreciate that. I would err on the side of caution, or at least be ready to. So work with your IT team to just, be able to create a web page. Our agency, whatever agent, said agency doesn't have any tax sharing agreements, and maybe then be able to provide that to CDTFA just as to cover your basis. Yeah. Stephanie looks like she said, would tax and revenue sharing include TOT? It does not under 2854. Does not include TOT, just sales tax. If we have an agreement, but the sales threshold has not triggered actual reimbursements, do we still need a web page to report this? Great question, Kristen. I would lean on that side, even if it hasn't met that threshold. I would create a web page. I would provide the contract, the tax sharing agreement contract on the website. You're gonna still, that covers you for when it does meet the threshold. You already have that established, right? And then you're still going to be reporting to CDTFA that there's $0, pointing them back to that web page that does at least contain a copy of the contract. And what'd you put in here? What do you expect from Squiggle? Marcus? Okay, I would, Marcus, you and I will talk later. I'm going to need some more information on Squiggle. Unless Ken and Susie, you know, you've got some there. Because I do not. Let's see. Amanda put into the chat from CDTFA website. Let's see. If a local agency has directly or indirectly paid, transferred, diverted, or rebated any sales and use tax revenues pursuant to the agreement in the immediately preceding fiscal year, then 7213 requires the local agency to report the fact CDTFA that fact to CDTFA and exempts the local agency from publication. Yeah. Okay. Awesome. Amanda, thanks for that ad. So you're not required to, but in the interest of transparency, which really I believe is the intent of 2854, for our perspective, and especially with Cal Cities, 2854 was an offshoot of the efforts of the city manager working group and kind of the desire to make sure that the tax sharing agreements there were, the information was available, right? As the city manager working group was trying to analyze and figure out if there would be changes to revenue and taxation code of how sales tax were allocated going forward, what kind of what's the depth of everything, whether it be Bradley Burns, whether it be transactions use tax. A lot of agencies would not like revenue and taxation law to change because of tax sharing agreements. And so it's, well, how big is that? And that's really the intent of 2854, is to gain the measure of, okay, when we talk about tax sharing agreements as a state, how much are we talking about? From where and how much? And so that's really the intent of 2854 as we perceive it. So even though it's not required, the intent for transparency might be still a good thing for you to prepare for. All right. And Jim, thanks for that. Regulation 1808, no web page reporting requirement if there's no sharing agreements. Perfect. Again, as much as we've even spoken with different folks at CDTFA, there hasn't been a tremendous amount of clarity. And that's really where the webinar on April 10th, I think I'm crossing my fingers that that's going to kind of paint the picture for everybody of exactly what, in easy to read format, as we like to kind of do here, is bullet point it, kind of tell us what we need to know. So I'm hoping for, that much more clarity on April 10th. All right. And I think that's it. Did we get them all?
Looks like that's all of them.
All right. Thank you guys again for sticking around so much, cutting into your lunch hour. Apologize for that. But a lot of information. Hope to be seeing everybody really soon with regards to our quarterly meetings and other conferences coming up. If you have questions, feel free to reach out. Information from the webinar will be made available. Good luck also in the coming months, wrapping up your budget for fiscal year 24, 20, or 25, 26 and beyond. Again, hope to see everybody soon. Thanks so much for your time today. We'll talk soon.
Thank you, guys.